So thank you very much. It's my honor to be here to join this very important event. So I'm going to talk about Chinese economy and give you an update a little bit. And then I'm going to focus on RMB internationalization. It's a quite different issue. But when you think about China's foreign economic policy, I think the RMB strategy actually comes into the center. This is not only China wants to reform the international monetary system, it is also we call it forcing force for domestic reform. Some people believe it is like a Trojan horse to invest external pressure for domestic reform and opening. So now, in the past years, China actually successfully managed a soft landing. The target rates in red line, the policy target rates revised down several times, actually setting a floor for actual growth rates. And you see this pattern very clearly. And this year, the target is ranged from the 6.5 to 6 to 6.5%, and I think the actual rate could be like 6.5 to 7, and this is lower than China's own past, but I think it's not too low compared with many other countries. And this is what really happened in China, and there are many discussions on the shift of the growth pattern, and this chart prove such shift. And you can see in red line the consumption, 77% of consumption contribute to GDP growth. And more importantly, the household consumption is the key force behind this, benefited from the rise of income and wealth of the previous growth. And of course, benefit from better coverage of social welfare. And export and import, we talk a lot about trade. So actually in China, the net export contribution, you see, is either negative or marginally positive in the past years. So it's no longer a driver for the whole economy. And fixed capital investment used to be the major driver, but now it's down to like 80% because of the deleverage effort. So now the biggest challenge for the Chinese government is working a fine line between cutting overcapacity and at the same time try to avoid to jeopardize the consumption, because there is going to be a repression on the consumption if the cut overcapacity too fast and too large, at too large level. And then, of course, the service sector is growing, surpass the industrial sector already. And this is what China wants, because service sector is the most dynamic sector in the economy. It creates jobs, opportunities. But of course, it leads to a lower productivity because of its nature. But we believe the lower growth plus the more balanced economic structure is a better mix than a high growth and distorted resources allocation. And this is what really China wants, and this is going to be continued in the near future. And now, what are the challenges? I think at first I want to focus on the exchange rate policy, because the nominal exchange rate has been a nominal anchor for the monetary policy for a long time in China. And you see the flexibility actually is a long-term objective. since 2005, but I didn't draw the longer data, but since 2005, there's been several regime shifts, from hard pegging to a soft, and then shift to a managed floating, and brought bans several times. And along this regime shifts, there is a huge appreciation trend starting from 2005 until 2014. And the most dramatic change was the August 11, 2015, and the PBOC, the central bank, decided to stop intervening the market, and somehow the consequences was the sharp depreciation and massive capital outflow. Well, you see, it's clear that there are three prices for the RMB exchange rate, and it's very easy for the investor to arbitrage between different markets, because it exists in both onshore market in mainland China, but also the offshore market in Hong Kong and in Singapore and any other, in London even. So this is something happened, and then the central bank reintroduced intervention again. And the most important step is to introduce we call it SIPS. It's a new index for the RMB exchange rate. So now, before, everyone look at the bilateral exchange rate against US dollar, and now the central bank wants the market to look at this index because it is more, it comprises of 24 currencies weighted in trade, and it has three factors to determine the equation. I won't go technical details, but somehow the purpose of this is to manage expectation, just like the US Fed, to try, and of course at the same time to allow more space for the exchange rate to fluctuate. So this is a mix of the previous effort of let the exchange rate float a little bit, and then to keep exchange rate stable at the current stage, because there are so many uncertainties, especially in the US, and there is a divergent trend of monetary policy. So it's quite successful, and the Chinese currency is one of the most stable currency. And then capital flow. Actually, this is another side of the coin. And you see the size of capital flow increased, and the volatility increased as well. This is the net volume of the flow. And for the past many years, China actually has a net inflow, but somehow now it's turned to be a net flow, outflow. And there are many reasons. I won't go through. But one of the most reason is there is a vicious link with the currency depreciation, and the Chinese government actually tried to block the capital flow, tighten the management, and now there is actually there are some people criticize this effort because they believe this is a reversal of the previous commitment of opening. But my understanding, this is a classic trilemma we taught in an economic textbook, because exchange rate stability, capital flow, and monetary policy independence are the three objectives that you can't achieve all of them at the same time. So now the Chinese government wants to have an independent monetary policy, because China is a big country. They don't want to follow the Fed's footstep to increase or decrease the interest rate, and of course the stability of the exchange rate. So the capital control is in place at the right time. But it's a very temporary measure because China really commit to open up. And if you look at the agenda for 2020, I think released in 2013, the third plenary, I think that was a really grand, ambitious agenda for reform and opening. And I think China is going to stick with that agenda, but somehow in a very sensitive period of time, there are a little bit withdrawal, but it's just a temporary measure. And then domestic I will go through is shadow banking issues related to bubbles, assets bubble, and it's very much like the previous, the crisis period of time. In the U.S., what happened in the U.S. linked to the real estate bubble, and of course the over debt. The debt issue actually caught much attention, and I draw this because I want to make a comparison between China and other countries and even some groups average. And you'll see China in a red line, and it's grow very fast, but somehow it fell in the middle range. And on the top is Japan. Japanese debt is super high. And then the advanced economy in the green line is somehow similar to Chinese level, and the U.S. the same range as well. And in the dark solid line actually is the world average. So it's not that very high. Israel, I try to draw a very low level, which is very healthy. So the problem is in the second chart. If you break it down, the corporate debt actually dominates the over debt level, and this is very a serious issue because most of the state-owned enterprises are involved with this cycle, which link to the non-performing loans in the banks. But most of the people assume that the implicit guarantee exists, but somehow, like I showed the shadow banking, there's no guarantee at all. So this is something that Chinese government really worried about. And but there is no systemic risk because you see the household debt at a low level, and the government debt is not very high. So actually there are some space for the redistribution of this debt level, and of course it's very dangerous for the government to carry out the deep water reform, like the state-owned reform, ownership reform, because the layoffs are always in the center of their concern. So actually the debt issue, the days ago, I think a month ago, the Standard & Poor's downgraded China's credit, and there are disputes about the methodology. And I think, indeed, if you look at issues, China's debt is not that terrible as many people think of. And of course, there are some buffers against downside risks. The growth rate policy target rate is always political objective. Believe or not, if once the premier says in the beginning of the year, we're going to have this target, and then you will have this the actual number. And then inflation is low, below target, there is much more room for monetary policy. And urban registered unemployment, and it's very low. And of course, reserves, you just mentioned China's reserves. I think this is really a buffer against external shocks. And of course, Chinese household saving is relatively high compared with many debt countries, even in Japan and many other countries. And this is really a cushion for the debt issue. And now the external policy, economic policy, the RMB issue. Actually the simple background is that China has become the second largest economy thanks to the opening and reform since 1978. And China now seeks for a greater role in international financial system. This is because, China and many other developing countries actually are underrepresented. And for example, China has successfully increased its voice in international financial governance, such as the quota in IMF and World Bank, and established new multilateral financial institutions. The AIIB is the most important step, and the BRICS, New Development Bank, is another one. And of course, China is really actively promoting G20, because G20 is at a political level to make decision, and it's a very representing the variety of countries, both developed and developing countries. And of course, regional Qingmai initiative, multilateralization mechanisms. Nobody noticed this development, but it's really important for Asia. China actually has a very special place in Asia, and this is, we call it Regional Monetary Fund. So gradually China expanded its financial power by many ways and work with the existing ones at the same time to create new ones. And RMB came into the center, as I said. It is not only for the global reshaping the international monetary system, it's also for Chinese domestic agenda, because the opening of the capital account is not a precondition for the RMB to be used internationally, but somehow it's a very important element for the currency to be accessible for foreigners. And just this is the idea of this currency. I won't go through, because if a currency wants to be an international currency, it has to be used as a store of value, medium of exchange, and union of account in all cross-border transactions for both private and public purpose. This is not definition of a currency internationalization, but it's somehow a guideline for checking the degree of the currency to be used internationally. So where is Chinese currency standing? So this is a reserve currency. I use this the data from the IMF, COFA, and where's RMB? It's right in the corner, 1.07. This is really a tiny share. But the biggest step was that RMB actually was included in a SDR basket in effect October 1st last year. And this is only the beginning. I think the next figure, we will see a bigger figure than this. Of course, US dollar, you see that a little bit decline, but not that much. Euro is 20%, it's similar to Deutschmark many years ago. And then as the unit of account, payment currency, Chinese currency ranked number 6. But in terms of share, this is still very small, US dollar dominating. And as the exchange of media, the foreign exchange transactions, I use the BIS data. You see the RMB actually from 0 to 4%. The US dollar is still dominating, and the second one is euro. Euro actually has a large gap to catch up with the US dollar. And in China's trade, the 29% of China's foreign trade denominated in RMB. This is a big step forward. And then the investment is 10%. And you see there is a up and down, the curves up and down because of the currency devaluation. And not many companies want to use currency as an asset currency. Of course, it's a summary. It's not complete. And now, Belt and Road. I think the picture of Belt and Road is bigger than anyone can think of. Actually, it's a Xi's vision. When you talk vision, I think it's quite. You can see it from different angle, and you have a different scope. And of course, for many Chinese, we believe it's Xi's vision for the next stage of globalization. Or in other words, how China globalize its economy, at least economy, in the next stage. And it has a multi-dimension partnership, strategy and policy, infrastructure, connectivity, and trade, investment, finance, culture, humanity. And it is project-based approach. This is very important because now you see many companies coming are state-owned enterprises. But sooner or later, I believe there are more and more private or non-state-owned companies will join in. And now in China, we have a called PPP model for this project investment. It's a public-private partnership. So once the private sector take part in, they have to consider whether the project is profitable or not. Otherwise, they won't survive. They won't put money in this project. So economically, once the more and more private sectors take part in, and then there could be a less concern of the true whether there are any hidden agenda behind this project. And of course, a few infrastructure gap, and transform savings into investment and increasing cross-border trade investment. Because I'm an economist, I try to figure out the benefit of this Belt and Road Initiative. And economically speaking, as long as it invests and can translate savings into investment, a long-term investment, not short-term investment, not portfolio speculating in flows, that could be an opportunity for the economy to grow and eventually to develop. So, of course, there are many spillover effects on local economy, and many Japanese economists, they analyze, because Japan actually took the first step to invest overseas, mainly in Asia, and they analyze the spillover effect on the host countries, like creating jobs or increasing the tax revenue for the local government. And that happened for many countries in Asia from Japanese experience, but China has very short experience. We need time to judge. And of course, because I focus on the RMB is going to play a role to provide RMB loans. I don't know whether here the Chinese companies, what currencies they use, but actually we encourage them to use, not US dollar, we use bilateral local currency to exchange. Why should we use the third-party currency? We can eliminate exchange risks by using our own currency in trade, investment, finance, and in many other aspects. And of course, Israel is a founding member of AIIB, as previous speaker mentioned. And I think the bilateral economic relation has been strengthened tremendously in the past years. And Belt and Road Initiative and of course RMB strategy actually can be a catalyst. I call it catalyst for the both parties to continue cooperation. And I think there are a lot of potentials for both countries to work together and to learn from one another. So this is my interpretation of this Belt and Road, and from a little bit perspective of the currency strategy. So I'm going to end this. Thank you.